All right. Welcome to the market of the moment, the week of May 30th, 2022. Chris Madrid, Michael Bolton in the house. Chris on the bag today, it looks like. Speed bag. All right. Well, finished up I guess the next to last month in the second quarter. We're getting into the last month of the second quarter of 2022.
Oh, yeah.
So as we've been going through the second quarter, interest rates been ticking up and down. Markets continued to rise. So today we're going to talk about some things and do our normal things. Chris, let's get started off with what's current mortgage rates, things looking like today?
Yeah, so for the week of May 30th, we are up from last week, right? I think when we posted this video last week, I was like, hey, we have a dip this week in rates. You guys need to get after it. Lock in, talk to your lender, do whatever you need to do to get this week's rates locked because it's the lowest that we've seen since rates started to go up, right? So I think we got down last week, we're in the 5.1, 5.2 range, where now we're in kind of the 5.3, 5.4 range, right? So it's just, again, it can't be any clearer that when I say you need to lock, you probably need to lock. Like it's, there's a good bet, a good reason for that. So yeah, I mean, obviously rates are higher this week. There is, obviously some information coming out tomorrow that may help interest rates a little bit. So we'll be on the lookout for that. One of the things from, obviously from this morning, so today it's the week of May 30th, but today's Thursday, right? Our normal Thursday when we meet. Stocks and mortgage bonds were slightly higher to start the day. One interesting that came out was from the CEO of JP Morgan, indicating that, hey, there's an economic, his words, not mine, brace yourself for an economic hurricane. He cites that the Fed's quantitative tightening or balance sheet reduction, which will begin this month, so the month of June, along with, of course, everything going on with Russia and Ukraine, could send oil prices to the 150, 175 mark, which again, we've been talking about inflation and how that impacts things across the board, right? I mean, it's for most families, I think it's costing $70 to $80 more at the grocery store, at the fuel pump. I mean, it's just, inflation's a big thing right now. The ADP employment reports came out and it showed 128,000 job creations in the month of May, which is significantly less than they were expecting. They were expecting 300,000 jobs being created in the month of May. So that's like one of the slowest gains, since the market, came back after COVID. So there's just a lot of things that are coming now. These type of things may be bad for our 401ks, right, or your stock portfolio or whatever it is. But from an interest rate perspective, any of these bad things in the economy tend to help mortgage rates, right? And that's the biggest thing that we need right now. So yeah, hopping over to the next slide. This is essentially how we track mortgage-backed securities. And like we had talked last time, so I want you to see kind of in between the two green lines, right? We can clearly see, man, a downward trend from 107, where we were back, when rates were at their lowest levels, or some of their lowest levels of January of end of summer into January. You can kind of see where, towards the bottom where it says July, September, November, and then January of this year, right? So we're looking at kind of a 6-month trend, and man, we can clearly see we went from 107 down to we're kind of in the 101.4, 101.5 range. So you can kind of see now the month of June. So if you hop down to that, but the furthest line on that right side, I mean, we're talking about, that's 400 basis points that we've lost from a mortgage-backed security perspective. So are interest rates going to be higher? Yeah, absolutely. So if you see, and this is crazy. Yesterday, I had a buddy of mine, a neighbor, text me. He went on CNBC, and I wish I would have sent it to you so we could put on this thing. he went onto CNBC's website, which CNBC's they're a media company. They're not even a mortgage company, right? But they had posted on their website a 30-year mortgage rate at 3.36 from. So this was day before. It was actually the evening of Tuesday night. So Tuesday night, he sent me a text. He's like, "Hey, can you lock in this rate for me?" I'm like, "No, dude, that's not even out there." So there's just a crazy, just it's insane, the stuff that we're seeing online. These online lenders posting, these 3% rates, or even 4% rates, and they're just not accurate. Or it's one of those things where they'll post it. They don't show you the 5 points or whatever that comes along with it, just so they can get the phone to ring and people to call in. So those are the things that you kind of have to be aware of, right? And at the end of the day, like you and I say, if something's too good to be true, it probably is, right? I mean, that's the reality. I mean, you're not going to have, most mortgage companies in the 5.4, 5.5 range, and then someone at 4% or 4.5, right? It just doesn't. That's just not how. It works.
Everyone's in business, right? So
Yeah.
yeah. And,
Yeah. So those are just some of the things you have to, obviously have to be on the lookout for. But
yeah, I mean, I think those things a lot are clickbait data collectors, basically. So now you're going to get advertised to by that mortgage company.
oh yeah,
The chances of you seeing enough, you might use them. So, but
yeah,
anyway, I'm not going to get 3.6 if nobody else can do it. You ready to move to the next slide?
yes,
So yeah, I wanted to, talk a little bit about, we constantly hearing housing bubble. Every time I turn on the news, they're talking about housing crashes and things of that nature. So we talk a lot on here about the housing crash and the fact that we really shouldn't be fearing one. And so
right.
we always show our data and our stats. So I pulled up a couple slides I want you to talk about here. And, the first one's just talking about lending standards and how they've changed since that 06, 07, 08 time period. Everybody thinks about the housing bubble, housing crash. There were two things happening. One of them was, very flexible lending practices. I'll let you talk a little bit.
Yeah. So
Absolutely.
Yeah. I can remember. I remember obviously going through this. I got into banking and lending back in 2002, and it's just so crazy kind of thinking back. Like, again, there's a pro and a con to everything, right? So now, right, nowadays, we have very well qualified buyers, really good credit scores, money in the bank, but they're self-employed, right? So being self-employed, you often have a little bit more flexibility with your tax, or your CPA rather has a little bit more flexibility with your tax returns. So being self-employed, whenever you either do a Schedule C if you're sole proprietor, or if you end up doing your business returns, there's a ton of things right within the tax code that you're able to write off. Now, the more aggressive or creative your CPA is with writing off a lot of those deductions, well, again, what it simply does is if you reported, hey, we had $100,000 in income coming through the business, but we had $70,000 worth of expenses. Those expenses are subtracted from that gross income. So you may have made $100,000, but what you told the government, right, the IRS, is that you made $30,000. So then from a mortgage company perspective, that's all we're able to use for your traditional financing options, right? So for your products that will go to Fannie Mae, Freddie Mac, ultimately the programs that are offering, probably the better interest rate options, those have to be what's called a QM loan, or a qualified mortgage. Now, since probably 2014. So if we look at the chart here in 2014, there was, obviously the revisions of QM and non-QM, rolled out in 2014. So what that simply meant was a majority of mortgage companies and banks are writing QM loans, or qualified mortgages. And that means they have to meet the minimum credit score parameters. They have to meet the maximum debt to income parameters, right? So if you're purchasing a home nowadays, you can't max out your mortgage payment by how much you make per month, right? So if you make 10 grand a month, you can't go out there and buy a house that's going to cost you 10 grand a month, right? In most cases, it's 40 to 50% of that gross amount is what you'd be able to qualify for, and that includes any current debt that you have, right? So if you make 10 grand a month, you're trying to buy a house that costs you $4,000 a month. Well, you can't have any more than probably $500 to $1,000 a month in additional debt. So that's credit cards, car loans, student loans, anything that would report to the credit bureaus as a minimum payment. It can't exceed that 40 to 50% number, right? So a lot of these things came into play before, obviously even before the recession. We can see the huge dip in mortgage credit availability, and that just means where banks and mortgage companies were lending money, right? So we can see that it was super loosey-goosey back in 2006, 2007, and it dropped. I mean, you went from 868, is that billion or million? Where is the number? Anyway, it's a lot. It was a huge amount of credit out there, meaning money being lent, right? And we can see that drop significantly just right above the 100 mark. Right as we were leading into the recession or the Great Recession, right? The mortgage meltdown of 08, 09. So, again, what that means is that any of those stated income, stated asset programs, right? Those are all gone. Any of the no income, no asset programs, those are all gone, right? And again, back in the day, right? So, shortly after I got into the business, you were able to go to a mortgage company and say, hey, I make $150,000 a year and I've got $100,000 in the bank. I want to buy a house. And they're like, okay, great. You have a 700 credit score. Let's get you to the closing table, right? It was essentially that easy. No verification, nothing like that, right? And again, fast forward to, again, even 2014, and definitely now, right, 2022, if you're going to get one of these qualified mortgages, right, which is going to offer you the better mortgage rates through Fannie, through Freddie Mac, you're having to essentially, all banks and lenders are crossing their I's and dotting their T's. Did I say that right? Dotting their I's, crossing their T's. So it's like, again, there's no way to get a mortgage now with just one of the four components that we're looking at, right? So just because you have a 750 credit score doesn't mean that you can just go buy a house. We have to verify that you can repay that mortgage, right? So you have the income to support it, that you have the money in the bank to be able to do your down payment and closing costs, and then your credit score and debt to income numbers all meet the parameters. So this is huge. Simply from a housing perspective, that out there in the market, the people that are in homes right now for the most part and are buying homes, they legitimately qualify, right? Yeah. So we're not going to see these huge swings in foreclosures. Now, again, COVID obviously made things very difficult, but again, the stimulus kind of stepped into where there was essentially no foreclosures because of COVID, right? There was the forbearance relief and some of those things that came out. So again, the notion that this is a housing bubble, we're going to have a ton of foreclosures or short sales and stuff like that on the market is just simply not. There's no data that we can find that's supporting that or that will support that, because it's just not accurate.
All right, let's look at another slide, and this is your volume of loans in billions with a credit score of under a 620. Going back to 2003, so basically Chris's timeline when he got into this industry, leading up to that bubble, people were getting loans with even lower than 620 credit scores, obviously, by the billions of dollars. Billions. Which, that last slide was there was 800 billion being lent back then, and it looks to me like nearly half
of that was people that didn't even qualify, really, right?
Wouldn't even qualify under today's standards. So
right.
I don't think we really need to spend a lot of time on this. That pretty much speaks for itself. And I guess the bottom line, in 2006, lending standards were much more relaxed than they are today. When we looked at our chart earlier, and even this one, it trends up in 14, 15, 16, 17, which leads me to believe that some of those stated income programs, I believe, were coming back to some degree. not completely stated. But then when we hit our pandemic time period, things seemed to tighten back up. I remember the weekend that the nation shut down, and basically the whole world shut down that weekend. We had several buyers just went from being able to qualify, and over the weekend, some lending standards had changed, and they didn't qualify at the beginning of the week. So anyway, we'll move on from that. Just always like to show the data to support the things we're saying.
Yeah, we're not just here talking, I promise.
As Chris says, people that are getting into homes now and that have got into homes the last 10 years have gotten into those homes with the bank knowing they were going to get their money back. So
yeah, or a high probability, right? I mean, there's no way to guarantee that someone's not going to lose their job, or accidental death, or some of these just these horrible things that happen. But again, for the most part, we are now having to adhere to a higher standard of making sure that which again, rightfully so, making sure that people that take out the mortgage, right, at the time that they purchase it, legitimately qualify and have the ability to repay the loan, right? They're working, they've got money in the bank, all those things that are needed. It's one of the questions that I get asked all the time is, for first-time home buyers, right? First-time home buyers, for whatever reason, think that they can go purchase a home with like zero money out of pocket. And that's not the case, right? I mean, there are like assistance programs and grants and different things that are available, but it's most likely going to cover one or the other, right? It's either going to go towards your down payment or it's going to go towards your closing costs. So you still need to have some money available to cover one or the other. And again, going back to the slide that we just looked at before, one of the big reasons for the meltdown was, in most cases, like for this one in particular, if you had below a 620 credit score, in most cases you were doing 5, maybe 10% down, right? Not the full 20, but you had some skin in the game. Where we saw the biggest drop as far as like or the rise in foreclosure and stuff like that was people that had good credit, 640, 660 and above. And you could literally buy a home with like zero to very little out of pocket, right? Like $500 or $1,000. There was like 100% financing loans. There was 80-20 loans where you're still financing 100% of the purchase. And then you could have the seller pay closing costs or build it into the price. I mean, it was madness, right? As far as that goes. Yeah. And buyers had zero skin in the game, right?
Yeah.
So if you purchased a home with literally no money out of pocket and you can't pay for that home anymore, you're like, nah, I'm not out anything, right? So I'll just let the sucker go, or I'll live in it as long as I can until the sheriff's coming to kick me out. So they've realized very quickly that, hey, for people that don't have skin in the game, they're more likely, so I'm sure somebody did a study that they're more likely to let it go, because they don't have anything to lose, right? So if you're buying a home and you have to put 10 grand or 20 grand or whatever it is down, you're less likely to just let that go, right, at the end of the day. So anyway.
All right, well, let's move on to our current real estate trends. This being the kind of the end of the month leading into the next month. I'm going to kind of skip last week's data. I know it was probably very similar. We also had Memorial Day weekend, and those things probably slowed down a little bit due to that. So, I wanted to talk today about, I wanted to get into, we've talked about inflation. Now we're starting to talk about recession coming on. And so obviously people are wondering, how's that going to affect the housing market and things of that nature? So today I wanted to show this particular slide. This comes from CoreLogic. Just wants to show the home price change during the last 6 recessions, dating back all the way to the 1980-81 recession. You can see that home value still increased by 6.1% to 3.5%. Only in 91, and then this time period we've been talking about with all these other slides leading up to this one, we see obviously a major drop in home valuation, but that's not necessarily a case of recession. That was a case of supply and demand, and supply at that time, I think we had 5 to 6 million new constructions on the ground, while you had a bunch of people with shaky mortgages that barely got into them. And, they had to end up dumping their houses. So you had a huge inventory of new builds on the ground and a huge inventory of resales coming onto the market at that time. So
Right.
the combination of that, obviously, you got nearly a 20% loss in pricing during that period. But as you can see, the point here,
And it's pure economics, right? It's pluses and minuses. If you have too much supply, the value goes down, right? And in this instance, there was not, it wasn't even too much. It was like above and beyond that.
Yeah. So as we get into this recession that is being predicted, it is still a good time to buy, because you are still most likely in the Dallas-Fort Worth market going to get 6%. These are national averages. So generally in the market, we add a few points to it because this is where people are coming. So even you can see 2020, after the pandemic, during the pandemic, we still had price appreciations. And I think some of these next slides I'm going to show you is even going to further solidify what we're talking about. So, I want to spend the last part of my time here just talking about, what does the rest of 2022 look like for the housing market? Because we are starting to hear about slowdowns, nationally. Obviously, it's hitting here a little bit as well, starting to see more price reductions. We're getting more builder inventory and things of that nature. So, what does the rest of 2022 look like for the housing market? Let's remember, these are national numbers. So numbers of listings increasing for our market, most likely. We're staying closer to the same, but we are seeing more come on. My 7-day tally from last week, I was seeing 1,200 homes come on the market with 9 to 1,000 being sold, where several months ago it was 1,000 being sold and only 700 or 500 coming on the market.
Right.
So, but it's really balancing out more than swaying one way or another. But I'm going to give you three reasons, three topics here of the 2022 housing market to kind of give you insight. So first of all, we are predicting realtor.com, and we are seeing that listings are increasing. I talked last week, Amy is getting emails every day, phone calls every day from new builds, from builders, sales reps with new construction inventory. This email after email, inventories coming up in August, September, that third and fourth quarter. So, and here's the data to show it. It's been increasing every month over the time period. But if you've been watching Chris and I's, market reports over these last 6 months, the Dallas-Fort Worth market, we're still been losing inventory up until, last week. I think we started seeing that tick up barely, but we didn't go from half a month to a month. We went from half a month to, 0.6 a month.
Yeah, 5/8.
All right, our next slide. We want to look at home ownership and how it's a hedge against inflation. That is another thing we're constantly hearing is our inflation. And if you don't know what inflation is, basically when your pricing of all your consumer goods is going up. So in the 70s, we saw inflation of 7.1%, but home price appreciation outraced it, and you got 9.9% appreciation in your home. So the point here is you took money out of other investments and you put it into a home. You probably made more money on your home than you would of those other investments. In the 80s, it was very much, the same appreciation to inflation. If you look at the 90s, you got a percentage point over inflation. So just like we showed in the other chart, during other times, home evaluation is still the best place, or excuse me, home investment is probably still your best investment. No, it's not liquid where you can turn it over overnight, but we are getting there. If we jump to 2021, last year, we saw 6.8% inflation, and this is where the talk has really been coming up. We haven't seen price increases in our consumer goods like this, for years and years.
Yeah.
But I don't know if we can see it, but we've talked and we saw 19% home valuations while we were seeing 6.8% in inflation. So although you were paying more for your gas and your food, your home was gaining more and more appreciation during that time period. So this, for me, is just basically to let you know out there that just because we're seeing price increases on all the other goods, you're also seeing it on your most important asset, your home. So you can sleep a little better at night, I would think, with knowing this.
Yeah.
And lastly, the experts say that prices will keep rising. This is a 5-year forecast. Chris and I was talking earlier. He can forecast this, and this is pretty much the same stats he gave us a couple of weeks ago, I believe. But you saw in 2022, we had a national average of a 9% appreciation, home price increasing. 2023, it's predicted to be nearly 5%, then nearly 4%, and then level off in that 3.5% over 25 and years 2026. And I always like to say, in our market, we're probably going to see 11 to 12 this year, and then we'll probably see anywhere from 5 to 6 in these other years. So well, that's just the forecast from the experts. I'm not the expert. I just study them and relay the message. So, but what this tells me is buying a home still good? Yes. Is it still a good time to sell? Yes. You've got lots of equity in your home, more than you probably ever had. You can use that to upgrade and move into that next part of your life. You have anything to add on that?
No, I mean that was a perfect segue to end. I just, I like to reiterate the fact of no matter what not no matter, right? But overall, like if we look at the 50-year average of mortgage rates, that's 8.5%, right? So if current mortgage rates are hovering in the the 5.4, 5.5 range, that still beats the interest on a rental, right? If you're renting and you're paying somebody else's mortgage, that's 100% interest, right? Versus 5.5, or I don't think we'll ever, at least in this time, I don't think we'll get to the the 7 or 8 range. But it's possible by the end of the year we'll be close to the 6s, right? But again, like we've seen historically, some of the data that we've provided, historically after a recession, we always normally see mortgage rates come down. It doesn't happen right away, but I would imagine for us, if we're headed towards a recession at the end of the year, in the next probably 12 to 18 months, we'll see mortgage rates come back down into the 2s, probably not. High 3s, low 4s, yeah, absolutely. So there's going to be a good opportunity to save some money down the road by refinancing. So again, at the end of the day, real estate is one of the best ways to create wealth or build wealth. And again, if you're renting, you're doing that for somebody else at the end of the day. So
all right, well, appreciate you, partner. Have a great weekend.
Yeah, man, y'all too.
Work that mortgage magic as always.
Oh yeah, for sure.
All right, and if you are a seller or buyer, get in touch with Chris and I, Amy and I. We'll get you on the right path, get you down the road. We've closed a couple the last couple of weeks. Got lots of new construction getting ready to close. all is good in our real estate world. So
Yes, for sure.
see
Get
y'all
off the
later.
fence. Get off the fences.
Get off the fence.